I'm Mark Santero with Homestead Advisors. I'm here today with two of our senior investment professionals, Jim Polk, head of equity investments, and Mauricio Agudelo, head of fixed income investments. And gentlemen, appreciate your time. And I wanted to talk about a couple of topics. First and foremost, 2025. And Jim, I'll go with you first, being you're right here to my left. What stood out for you from an equity markets perspective that kind of summarizes 25 and what drove U.S. equities this year?
Yeah, I mean, I think the word I would use would be resilient. The fact that the market, despite a hiccup in the first quarter, really was able to absorb the tariffs that were brought on and talked about late last year. So that was the big thing, I think, the resilience of the market. And then the second big theme was AI, which, really was pervasive in the market, and spending that's going on, the long-term implications of that. So those were really two of the big, I think, themes that happened in 2025.
And from a thematic standpoint, S&P as of December 2nd, over 17%, obviously positive influences on U.S. equities.
Yeah, I mean, the economy is held up reasonably well. Obviously, pockets here and there, but generally the consumer remains strong. And again, the AI narrative is driving a lot of the growth in earnings. And that's been a big part of the story this year.
Right. Well, thank you. So, Mauricio, same for you, but from a fixed income perspective, what were the drivers and what stood out for you in 25 so far? We still have a couple of weeks to go.
Yeah, I think on the fixed income side, what stood out for me is the Fed pivot from addressing inflation to cutting rates 25 basis points in September, 25 basis points in October, mainly driven by the softening labor market. And with that, it also came the steeper yield curve. So, two stands, have steepened. We were coming off a significant inversion in the yield curve. And so, here we are today. And as Jim mentioned, as well on the fixed income side, the resilience of the credit market. When we look at credit spread for the year, we are basically unchanged. We have had a fair amount of volatility throughout the year. And we have also had a fair increase in new issue supply on the corporate side. We're running right around 8% on a year-over-year basis.
So before I close the books on 25, prior to this year, the Federal Reserve, which drove equity markets, drove the fixed income markets, now it appears that other influences, tariffs, geopolitical issues are driving the Fed, which are driving interest rates. Do you agree with that sentiment that the Federal Reserve is, not the driver of the markets? It's kind of the other way around?
I think that's a fair way to put it. I will say the Fed still has a big say in the market. They have announced that they're stopping quantitative tightening, right now. So liquidity still matters a lot for financial assets.
And I would say, yeah, from the equity market side, the Fed still is relevant.
I'm not saying it's not relevant,
yeah.
But in April it was Liberation Day, and then it was the reversal of that. So it kind of drove markets more so on the equity side than anything else.
Yeah.
Okay. Well, let's put that in the rearview mirror, because our investors, obviously appreciate the returns, but want to know what is our opinion going into the new year, which is only a couple of weeks away. So I'll start with you, Mauricio. What are the tailwinds? What are the opportunities you see in the fixed income markets going into 26?
I think the opportunities for the fixed income market, mainly what we saw this year, it's an income producing environment for fixed income investors. With the current dynamics in credit spreads and where we are in the cycle, we favor the higher quality names versus reaching for yield in the low triple Bs and into high yield. So we want to see a high quality portfolio with an intermediate duration bias in that 3 to 7 year, 3 to 10 year part of the curve to take advantage of the dynamics of the yield curve. You're going to be capturing roll down opportunities as well. That's where we are, and you have to be selective in credit. We have to be really selective, and being an active manager in this environment will be very helpful for our investors.
So investors with the steepening of the yield curve, especially if we have another rate cut in a week or so, you're going to actually get some pickup, a little bit longer duration, whereas the last couple of years it was relatively flat or inverted.
Yes, that's correct.
Okay. So Jim, what are the tailwinds? What are the opportunities in the equity markets going into 26?
Yeah, I mean, I think 26 will be like 25 in the sense of I think AI will continue to be an important part of the growth and earnings of the market. I think that's to be expected and might go on for several years. I think it would be really helpful to see a broadening of the market. The consumer, as we said before, like the consumer is relatively healthy. There's certainly a wealth effect with the market doing as well as it's done for the last few years. So if the consumer remains healthy, that's a positive. And then the third thing has been just, industrial production has been weak for a number of years. And if we're troughing at this point, and not to say we are, but if we are, I think that could be another tailwind to the market. Valuations are reasonable, but they're not outlandish. They're not super cheap either, so that seems like it's okay. But for us on the value fund, we're looking for high quality companies that we can own for a long time, and so we remain focused on finding those higher quality names.
Okay, so let me go back to you.
Sure.
What are the headwinds, or what are the potential stumbling blocks, pitfalls in the economy for equities going into 26?
Sure. I mean, well, I would say AI again. That's if there were to be a stumble there,
Is there a bubble?
That's been sort of bandied about for a while, and that's a question mark. That remains a question mark. So if there is a stumble in the AI narrative, I think that could be, a negative to the market. Could be geopolitical. I mean, it could be something exogenous that we're not even thinking about. But, and certainly there could be volatility in the market. We don't think it's going to go up in a straight line. But in general, it's a relatively, benign market at this point.
Okay. Mauricio, from a fixed income perspective, are there any potential bubbles out there, or any headwinds that you are concerned about going into 26?
I think an area of concern for us in the market is the private debt, and has been widely talked about in the media. But a lot of these infrastructure, AI, utility, data centers, they're being financed through a lot of vehicles in the private debt market. It is to be seen. It is a market has yet to be tested during a down cycle in the economy. So that's an area of concern. I think it also concerns me not the potential, but I think it's very minimal at this point. But if we have an uptick in inflation while a declining environment in the job market, that creates an environment of potential stagflation, which would be very problematic for the economy and the Fed to deal with.
Last question, and I didn't prep either of you for this one, so it just came to me. So are there if you had one prediction for the 26th for a holiday gift for our investors, what might it be? It doesn't have to be market related.
I guess a holiday gift would be, a settlement and peace in the Ukraine,
Okay.
and a resolving of that war.
That would be wonderful for many, many millions of people. Mauricio, anything from you?
I think from me it will be reassurance of the Fed independence going forward.
Which remains to be seen. And for me, I want to wish all our shareholders and people that represent our funds for their clients a very happy holiday season. And thank you for your support of Homestead Funds. Appreciate it.